Everyone is anxiously awaiting what the Bank of Canada will do this week when it comes to interest rates. The great minds here are expected to cut the key lending rate by a whopping 0.5 percentage point. And that's good news for people who are looking to buy a home or who have debt to pay off. So what are the signs pointing to this change? Well, inflation has gone down to 1.6%. That means that prices are going up, but at a slower pace. And that's good news for consumers. And the Bank of Canada has been aiming to get inflation around its 2% target to get the economy under control. Bank of Canada Governor Tiff Macklem has signaled the bank is willing to start cutting interest rates even more.
We want to see growth pick up. We want to see consumer spending strengthen. We want to see a job growth pick up. If the economy is materially weaker than we're expecting, inflation's weaker than we're expecting, it could be appropriate to take a bigger step.
The central bank has been lowering rates already 3 times this year so far, each time by 0.25 percentage point. The key interest rate now sits at 4.25%. And the cuts have had an impact. The economy has continued to grow modestly, but there are still signs the economy is lagging. Real gross domestic product has shrunk on a per capita basis for 5 quarters in a row. And the labor market has slowed down. Unemployment was at 6.5% in September, a full percentage point higher than a year ago. The housing market is still tepid. Interest rate cuts were expected to stimulate the housing market again. While home listings have increased, demand is low and home prices are flat. So what's going to happen going forward? Well, with the gloomy economic backdrop and plummeting inflation, forecasters are convinced the Bank of Canada will deliver another jumbo rate cut in December, bringing the key interest rate to 3.25%. And the parliamentary budget officer predicts the Bank of Canada will continue cutting interest rates until it reaches 2.75% next year.